Good morning, everyone. I am Bagger Don at Stock Market Caddy, and today is Tuesday, February 3rd at about 10:45. You're looking at a chart courtesy of StockCharts.com called a point and figure view, and it is of the S&P 500, the SPY. X's means prices are accelerating. O's mean that prices are pulling back or decelerating, and the buy and sell signals are precise. When an X, as in this one here, exceeds a previous X column, it's a buy, another buy. When an O breaks down, which we don't see here, we don't see here, we don't see here, we did see here, would generate a sell signal. It's black and white. There's no gray area. The buys are the buys, the sells are the sells. The overall trend, as you can see here, is up. Now, there's a situation that has us and should have you very concerned if your IRA monies, your portfolio, are invested in the S&P 500. And the reason is that a rising tide of the index or of an ETF will raise all boats, most boats. But a lowering tide, in the event that we go into a correction, will bring most boats down. This pattern you may be looking at and saying, well, Don, this is a buy signal and yet another buy signal. Well, this is true. But when we go back and we look, this was the sell signal. Here was the buy 1, 2, 3, 4. We had 4 buy signals in a row. When we get to 6, if we ever get to 6, it usually means exhaustion, and we can see a precipitous move back. Very similar to what recently just happened with a point and figure chart that we did in silver. But this pattern, I'm going to draw a line here. Do you see this? It's almost like a megaphone. This type of pattern, a widening pattern, many times signifies to us a significant topping action where the prices are getting exhausted. So if we get a pullback, we will get a series of O's. But what we're anticipating is that the next pullback could very well come back down to, on the SPY, 651, or in the S&P cash, 6,500. And if this breaks here, if we got to first pull back, and then we got to get to this level right in here, if we get there, and then if this breaks, there's little to no support until down in here, which would be 572 or 5,700. From where the S&P is now, that's over 1,200 points. The likelihood is, too, this is very little support here. This is all momentum. Momentum. Momentum up is a beautiful thing. Momentum down, not so pretty. It can take out all the leverage because as people begin to get profitable, they keep leveraging up, trying to make more and more money in a shorter and shorter period of time. And when the market reverses, they're not prepared for it. They don't have a discipline, and they're not prepared to exercise any discipline, and then they get crushed. We could come all the way back to here, 523. That would be almost 2,000 S&P points, 200 points here. Would be a significant pullback. And if this trend doesn't hold, and all the headlines will be blaring about a bear market, we could be down in here. Now, ultimately, and over a period of time, the markets would, of course, balance out. But they're not obligated. They are not obligated to do as they did here when they pull back. And you can say, Don, well, they pulled back here, and they ran right back up to the top. And yes, they did. But they're not obligated to do that. You never know. So you always want to protect Rule number one, if you lose only a little bit of money. Rule number two, observe rule number one. Rule number three, observe rule number two. Only lose a little bit of money. Do not lose 30, 40, 50% or more of your overall portfolio, because if you do, a 50% decline means you must go up 100% just to get back to even. And what will make it very difficult to get back up here is that there are people that bought for the very first time up here. And if we get that correction as we come back, we'll never quite get there. They'll be looking to get their money back. They want to get back. They want their bread. And what do? They sell. We refer to that as resistance. If you punch in the QQQs, it's much the same. These markets, these ETFs, have been commoditized. They're just like silver. They're just like gold. It's just people, institutions trying to make money. Most have no discipline. And if they have no discipline, their decisions are based on greed and fear. And that's never a good thing. Wall Street and Madison Avenue is one and the same. They bank on the retail public making investment decisions on both greed, it always comes back, and fear. The world is ending. It's neither. But sometimes it can be. And that's where the life of a trader, we're always mitigating, preparing for the best, or hoping for the best, but preparing for the worst, and using technology day in, day out to extract cash flow from the money flow. So this is a very static view, and I'll erase this so you can get a clean shot of it. But I would be very concerned that the S&P, we'll get a little line in here for you, bear with me, could very well be headed down here. Now, it may take us a few weeks, but Don, it took us months to get up there. Yes, prices go up much slower. They go up very fast at the end. As you can see, they go up very fast at the end. But over time, it takes months for prices to climb, to accumulate those resources. But when they come down, they can come down very fast. So this is where we are today, up in here. We'll be looking for the pullback, the 3 O's, and then we want to see what happens here. Does 651 hold? And if it doesn't, then we'll be looking for this type of action. I hope this helps you. I hope it saves you some time. I hope it saves you some money. And I hope it saves you a portion of your portfolio. If you want to learn to trade or to invest your own capital in a disciplined, patient, not necessarily in a speculative way, not saying that at all, but playing defensively, be sure to visit stockmarketcaddy.com. I am Bagger Don. You can call any day from 9 a.m. to 9 p.m. at 813-758-8263. Good luck, everybody.